First Time Homebuyer Seminar. We call it a First Time Homebuyer Seminar, but everyone's invited. Even if you already own a home and you want to refresh the information, you're invited. Today our goal, we have a short period of time, but our goal is to teach you as much as we possibly can about the home buying process and help you alleviate as many fears as you can, because it is a very fearful thing, which you'll hear throughout this seminar. We have a great group of presenters tonight, and we're going to start with Mel Wilson. And let me just tell you a little bit about Mel Wilson. Mel Wilson is the owner of Mel Wilson and Associates, Realtors. Mel has been a real estate broker in Northridge for over 30 years with his own firm, which I just said. Mel will speak about the role of your real estate agent and home ownership. Next, you will hear from our team of mortgage experts from Wells Fargo in the Encino office. And the office, I believe, is on Ventura Boulevard, correct? They're going to talk to you about the importance of choosing the right lender. And I'm going to introduce each one of them now, and they'll tell you more about themselves later. We have Jeff Neinstein, and Jeff is the branch manager of the home mortgage department. We have Jacqueline Mills, who's a home mortgage consultant, and we have Fernando Arboleda, who is also a home mortgage. Did I pronounce that right? He's also a home mortgage consultant. And finally, every year we have a real estate attorney. We have Robert Carlson with us. But Bob had an emergency tonight, so we have his partner, Morgan Halford, with us tonight, and she is a real estate attorney as well. And she's going to talk about the aspect of understanding disclosures and taking title, understanding the legal aspect of disclosures and taking title. And welcome, Morgan. We're so glad you could join us. Thank you. So we're going to have each speaker speak from 25 minutes to 30 minutes, and then we'll take a break and take questions from that speaker. So everybody, you have pads in your folder, so you can write down the questions as we go, and then you'll be able to ask that presenter the specific questions to their topic. And then afterwards, at around 6 o'clock, if you want to remain and ask additional questions, there'll be about a half an hour to do that. And if you can't, we understand, and you have to go, make sure you grab something to eat on your way out and something to drink. And again, welcome for joining us and being here, and I hope we really can help you out in this home buying process. Thank you. And now with that, I'm going to introduce Mel.
Thank you. How's everyone? Good. I'm a little bit stiff. I've been on the freeway from San Diego. I'm a member of the National Association of Realtors Board of Directors. And our board meeting started yesterday, so I did not want to miss you. So no one can fall asleep. All right. I have this little gadget here, and hopefully I won't trip on it. But, right, okay. This is the advance. Okay. All right, so let me just take a brief survey of you. Let me take a brief survey who the audience is, okay? How many of you have bought a home before or do real estate before? A few of you. Okay. How many of you are interested in buying real estate? Okay. What are the rest of you here for? Okay. Where's my assistant, Jasmarie? Is she here?
She's right here.
Okay, Jasmarie, you must stand. Jasmarie Capps was a student here at Cal State Northridge, and I discovered her in an industry night. You all hear about industry nights? Mm-hmm. And so I asked her, well, at least my colleagues asked her if she was interested in taking an internship at our company to learn more about real estate. And she said yes. She said yes. She graduated with a business law degree, and she wants to be an attorney, but right now Jasmarie is studying for her real estate license, and she's my full-time assistant. So how about it for Jasmarie? All right. So we're going to get started, and hopefully I'll get this right. Does any of you know what this is?
Cell phone, smartphone.
It's a phone, right? It's a smartphone. Anybody have a flip phone? Anybody here with a flip phone? Oh, okay. We won't point you out. Okay? But real estate has become very mobile, and we'll talk about what is involved in buying a property and the ins and outs of it, the pros and cons of it, the advantages and disadvantages. And there are some disadvantages of buying real estate. So it's not for everyone, or it's not for everyone all the time. Okay? So let me see if I can. Kyle?
Yep,
I'm going to do my best.
go for it.
Let me see if I can get my this answer working here. Ah, it's working. Okay. So we're going to talk about these things, okay? Market conditions, steps in the home buying process, why use a realtor, the elements of choosing a home, and the escrow and closing process. So that's what we're going to talk about today. And hopefully by the end of this session, which I'm going to try to get through pretty rapidly because I have some other speakers and I know you are anxious to hear them as well. Okay, so economic conditions. Did you all know that, oh, this is the old one. This is the old slide. The interest rates actually, the unemployment level has actually gone down to 5%. That's okay. It happened last week.
Oh, thank you.
It happened last week. So the National Labor Statistics shows that the unemployment level is down to 5% now. And in California, it's just under 6%, okay? All of you are employed, so you probably don't care about that as much, right? You do, or you don't?
We don't.
Yeah, okay. All right, so some of the employment things that have happened over the last several years, and hopefully I'm not blocking anyone over here, but here's what's happened with the employment growth. You can see what happened in 2009. It was pretty bad. Last month, the labor statistics showed that there was over 270,000 new jobs created, and the majority of them were private sector jobs that were created last month. And so interest rates have been, I would say, at record lows. I've been in the business, well, let's just say I didn't have any gray hair when I got in the business. And interest rates at that time were about 10%, and then they went up to as high as 18% for a 30-year fixed rate loan. For the last couple of years, they've been around 3.5 to 3.75 to 4.25%. So it's really at record lows, and this is a great opportunity for one who's thinking about buying real estate, okay? Here's some of the things that you might want to think about, where the job markets are. If you are thinking about moving out of the area, you'll see where the job growths are at. You see here in Los Angeles, we do have some job growth here. Oh boy, this is pretty good. Ambidextrous, I can just do one like this, right? Okay, here are the types of jobs that are out there and the growth in the various industries. You see here educational services. That would be probably most of you. Would you agree? Yeah? It's okay to say shake your head. All right, so consumer confidence. This is what consumers are thinking. Over 100 is just off the charts. And you can see back in 2009, the confidence was pretty low, and it's been gradually going up, and then we had a dip in 2011, and then it's back up again, a little dip here, but up. So folks are thinking that things are going to get better. That's what consumer confidence is about. Things are going to get better. So let's talk a little bit about the California outlook. Homes, for example, if you were to buy a home in the Bay Area today, you're probably going to pay for a two-bedroom condominium, I would say about $750,000 for a two-bedroom condominium, and that might be about 1,000 square feet, right? In our area here in the San Fernando, Santa Cruz Valley, the median price is more like $480,000, so half of the folks can buy a home above that level, and half can buy below that level, okay? If you go to the Moreno Valley and places like that, a little bit further out, Antelope Valley, you'll find lower pricing. Usually the prices are lower the further you get away from the job markets, okay? All right, so mortgage rates, Jeff and Jackie and Fernando will talk to you about those, but you can see the trend lines here. They're all pretty good. And let's talk about equity. Equity is the difference between what you owe and what the property is worth. Back in 2007, equity was up pretty high, And then we had something that's called a recession. Anybody remember that? And a few people laid off, and thousands of people were losing their jobs, and the equity was diminishing. And so equity now is going back up. The equity, again, is the difference between what you owe and what your property is worth, okay? And so it's a pretty striking thing. We're going to talk a little bit about who are the buyers today. The medium-age buyers, so half of the buyers are 44 years or above 44 years old, and half of the buyers are below 44 years old. The lion's share of the buyers today are what we call the millennials, the folks who are in this age bracket here. So don't be fearful if you're a millennial. There are a lot of you out there really thinking about buying homes today, and this could be a very good time for you, and particularly at this time of the year where real estate goes in cycles, and usually around the holidays the market slows down a bit, and this usually the best time, if you have a choice, to buy a property is right between, I would say, Thanksgiving and about the second week in January. Did y'all hear that? What's the best time to buy?
Thanksgiving and the second week of January.
Very good, very good. Okay. And this shows you here something about the investment opportunities where people invest their money, real estate, gold, stocks, mutual funds, different places. Some people just stick it in the mattress. Okay, so renters, and what are renters thinking? A lot of the renters are thinking, why am I throwing my money down the tube? You know, so if you're thinking about getting a job transfer, you probably don't want to buy real estate now. If you're thinking you may get laid off, you probably don't want to buy real estate right now. If you're thinking about, you know, separating from your partner, you probably don't want to buy real estate right now. Okay, let's end on a good note. Okay, all right. All right, so here are the main reasons that people are buying homes. They're just tired of renting. They're tired of throwing their money away. They want a place that they can live in. They want a larger home. They may be getting a job transfer. They just want a better location. And a lot of folks are thinking about buying because they want a tax benefit. You know, when you rent, you don't get much of a tax benefit. Did you all know that? But when you own, you get the benefit of writing off the interest and the property taxes. And if you own a property that you don't live in, that you use as an investment, you get an additional write-off with the depreciation of the structure. Okay? So there are a lot of benefits to owning a home, and some of the detriments of owning a home really is that you may not want to be tied to a mortgage for 30 years, although the majority of the homeowners who buy a home do not keep a mortgage for 30 years. They usually keep it about 7 years or so. But you may not want to make that kind of a commitment, right? So that's one of the reasons you might not want to buy. You may not want to have to be responsible for maintenance and repairs, upkeep, all those kinds of things. So that's another reason that you don't want to buy. If you, and another one would be perhaps you're thinking about moving out of the area. You probably don't want to buy a home now if you're thinking about moving out of the area. Okay? All right, so home buying process. You have, these are the parties involved in it. These are the players. I was a player here. I used to play a sport called football. Anybody know what that is? Do you know this university used to have a football team? And they don't now. Okay. But I played here many, many years ago. I was a business major here, and I graduated with a business degree. I studied accounting and management, and I know about being on teams. The buyer is another one of the players. The realtor, or a real estate licensee. Okay? The difference between a realtor and a real estate agent, for example, they all have a real estate license. They're licensed by, in this case, the state of California. But a realtor belongs to the local association of realtors, the state association, and the national. And when they join them, they agree to abide by the code of ethics. And so those folks who don't want to abide by the code of ethics, many of them don't join the local real estate association, so they have no one that's going to hold them accountable in case they do anything that's kind of, you know, shady, not good. But so there is a difference between a realtor and someone who's not a realtor. So you might want to ask them, are you a realtor? Then you'll know you have that extra safety in case something goes awry. Lenders, they're major players. We have Wells Fargo here, and these folks here are really good at what they do. They've done it for a long time, and they have a lot of good products that they can help you with. The escrow is a process that you go through when you are buying a home, and the escrow company is a neutral third party who is a depositor of all the paperwork, the loan documents. They are responsible for making sure that the principals in a transaction, and the principals are the buyer and the seller, that the agreement that the buyer and the seller has usually is agreed to in writing. In California, it must be in writing in order for it to be enforceable. It has to be in writing. And then once the buyer and the sellers all agree to the terms, that's a fully executed contract. Morgan will tell you more about that piece of it. And once you have a fully executed contract, you want to open up what is called an escrow.
Excuse us.
Oh, it's okay. No problem. Did you bring lunch? Okay. So an escrow company is a neutral party, third party, and they are the custodian, so they can't take sides. The escrow company takes the instructions from the contract that the buyer and the seller agrees to. The realtors cannot change the terms. One party, for example, if the seller wants to change the term from, I want to close escrow in 30 days, and they've agreed to close escrow in 45 days, they must get the buyer to agree to changing those terms. And that's called amending or changing the escrow term. So once you have an agreement together, you are tied together until the transaction completes or the transaction stops or cancels. Okay? All right, so let's talk a little bit about what's happening. We're in a market that the inventory is very, very tight. And so a normal market is if there were enough homes on the market to supply the demand for 6 months of home buying. Today, there's about 3.5 months of inventory of homes on the market, in our market, okay? And our market would be the San Fernando Valley, Santa Clarita Valley, the Antelope Valley, Simi Valley, Conejo Valley, all these surrounding valleys here. That's where our market is today, and it's a tight market for inventory. And so there's a good chance that when you write an offer on a property at the median price, which we said about $480,000 or below, you're going to be in competition with multiple other parties who want to buy the same property. So be prepared for that in this kind of a market. We're in what is called a classic seller's market, okay? So a seller's market is when there is more buyers than there are homes or properties for sale. What's a seller's market?
More buyers.
Oh, this side of the choir heard, but that's well, okay. So a seller's market, they have more buyers than there are properties available for sale. So what's a seller's market?
More buyers than there are properties.
Okay, we're gonna go with that. Okay, major steps in the home buying process. Decide whether to rent or buy. It's your decision. It's not anyone else's. Well, maybe it's your parents if you've been hiding out with them and they want to kick you out, right? But I'll tell you something. If your parents are trying to boot you out, negotiate with them. Okay? Say, look, you got to give me the down payment and I'll get out. All right? Okay, go online to search for properties and also search for amenities in the community. Things like the school rating. Even if you don't have kids or don't plan on having kids, having a school rating that's higher is better because the values will go up. There are parents who buy properties in an area that has a good school rating and they have no intention of having kids. But they know the values will go up. So you always want to look at the school rating, okay? Also look at the crime rate, right? And look at the amenities. How close is it to your work? How close is it to your family members or other places you want to be or places you like to hang out at? Decide how much you can afford. That's your choice. You may be able to qualify for more than you really want to pay. So don't let a realtor or anybody else push you into getting a higher priced property if you don't feel comfortable making that payment, even though you can qualify for it. Did y'all hear that? Okay. All right, so get approved, pre-approved. Go to Jeff. Go to Fernando. Go to Jackie, right? Get pre-approved because without your pre-approval letter, when you write an offer, your offer will be DOA. Anybody know what that is? Dead on arrival. Because we're in a market where it's very competitive. If you do not have pre-qualification ahead of time, when you make your offer and you say, oh, I'll go get, my credit is good, you know, I know I got bank, you know, right? Get pre-approved. Because if you try to get your offer accepted, they're not even going to look at your offer. They're going to say, well, are you pre-approved? Can you verify that you have the funds sufficient enough to close the escrow? And if you don't, you're not going to have a very good success rate in getting a home. Decide the price, the type of home that you desire. Once you find a home, you must carefully inspect it. Did you all hear that? You must carefully inspect it once you have a home. Do not waive your inspection. Did you all hear that? Can we say, do not waive your inspection? Oh, that's not good enough. One more time. Do not waive your inspection, because that's your opportunity to see what's going on with that property. It may be perfect. And don't bring Uncle Joe over there to look at and, kick the sink and all that stuff. Get a certified inspector who can give you a real report, someone who knows what they're doing. All right?
Will you be talking about assessors also, what the difference is between inspector and assessor?
No, I won't, but if you like, I can. Okay? She wanted to know what's the difference between an assessor and an inspector. Inspector, there are many different types of inspections you can get. They inspect whatever the systems that you ask them to inspect. A home inspector will inspect all the plumbing, heating, electrical, air conditioning, appliance system. An assessor is somewhat, you meant an appraiser or an assessor?
Oh, that's what I meant.
I thought so.
Yeah.
You're trying to trick me.
Yeah.
The appraiser is one that evaluates the value of the property compared to other properties in the same area. So that's what an appraiser does. And most of the lenders, in fact, I don't know any lender that will make a loan without having the property appraised at the value that you agree to buy it at. Okay, so you always want to get an appraisal on the property. It tells you, is this property really worth what the seller is thinking it's worth? Okay, good question. All right, so, that's kind of promoting myself. All right, set an appointment. Where do you want to live? Think about it. Do you want to live near any of these amenities? Some people want to live close to a dog park, right? Because they have, the dogs is their most important friend, right? And so you want to think about these kinds of things when you are thinking about where you want to live. All right? Here's something that's really important. Fair housing laws. It's a right. You cannot be discriminated against. It's against the federal statute. I think it's against the state statutes too. So you want to make sure that no one is treating you unfairly, right? Okay, work with the realtor, and here's some of the benefits. They help you find your lifestyle home. People are buying lifestyles now. They're buying lifestyles more than they are really a house. They're buying a particular lifestyle. Help you understand the market conditions. They'll provide you with updated disclosures so that the seller's telling you everything that they know about the property. Some sellers may know some things that they don't want to tell you, but they're required by law to tell you what those things are. Okay? They'll help you determine how much buying power you have, and so will your partner and the other team member, the lender. They'll help you determine the value and the condition of the property. They'll negotiate the terms. They'll guide you through the entire closing process from the beginning throughout the closing. And just after it closes, they're going to still stay in touch with you to make sure that everything worked out okay. All right, so establishing a relationship with your realtor. The state of California says that we have to disclose what the agency relationships are, and Morgan's going to tell you more about that. So I won't get into the details, but the bottom line is that when I was in school here, I took a business law class or two, and there was a term that was called fiduciary. Anybody knows what that means? Well, I just break it down real simple. Someone who's going to fight for you. Someone who's on your side, not on their side, not on anybody else's side. They are protecting your interests. And an agent must describe to you what relationship they have with you and what relationship they have with the seller. Okay, here's some of the steps in the home buying process. Earnest money means a deposit, not a down payment. It goes toward the down payment, but it's a deposit. And it's pretty typical to have a deposit of about 3% of the offer price. About 3% of the offer price. That deposit is good faith money that is being held by the escrow company until all the terms have been met with your agreement with the seller. Okay? And then it goes toward the down payment or closing costs. So it's not like you have to come up with extra money. But there's also something that's called a down payment, and they're going to explain to you what that is. So a deposit, and then the escrow period is the process that you're going through where you're getting your loan approved, you're inspecting the property, you're looking at the title to make sure it's clear, you're going through all the processes of trying to get your transaction closed. There are all kinds of down payments. In fact, I think you guys may have down payments lower than 3.5%, right? Do you? Yeah. So there's all kind of great programs out there. So disclosures, make sure you ask for certain contingencies. I think there's going to be a place where you can get all this off of a website. Is that right, Linda?
Yeah.
Okay, but I love taking notes when I'm listening too, because that's how I process things. So you and I think alike. Okay. All right, so Termite inspection, septic tank. If you're buying a hillside property, you might want to have a geological inspection too. If you're buying a property that's kind of leaning like this, you might want to have a structural inspection, right? Right? That's not a low-rider property, that's a property. Okay? How to get your offer accepted, you know, you use a realtor who knows what they're doing, get pre-approved. Some people believe in prayer, I do. But you know what? And some of you are praying, I hope they don't accept it, I'm so scared. All right, so successful negotiating and offer accepted, okay? All right, escrow and closing process. Here are the steps that are involved. I know I'm going kind of fast, but I just want to leave time for questions, okay? All right, so inspections, here are some of the types of inspections. Everybody got that? Okay, and there could be, as I said, geological inspections too. All right, it could be inspection on a well if you're buying a property in a rural area, like a water well or a septic tank or a cesspool. There could be other inspections too. All right, so here are some of the common mistakes of first-time buyers. Raise your hand if you're a first-time buyer. All right, so don't make these mistakes, okay? Pay attention to this part. Here's what a lot of first-time buyers fail to do. They don't consider whether renting is a better option for them. As I said, owning a home is not always the best option. I'm kind of biased. I think it's a good option, but it's not good for everybody all the time, okay? So make sure you know you are committed to buying. They're not prepared to compete in an all-cash offer. Did you know that this year about 22% of all properties that are being purchased in this region are all cash? So talk to grandma. Tell her to come up, get some cash, right? All right. They put the car and other extravagant living before the home purchase. So if you are really a person that likes fashions and you like going out to the local play and you like taking your friends out and all that stuff, stop it. Okay, if you're buying a house, cut back on all that stuff. All right, and don't run up your credit cards anymore. All right, put too much faith in online information. They think everything is the gospel online, but it's not. Did you know that the internet is not regulated? Did you know anybody can put anything they want on the internet? You guys didn't know that? Oh my gosh. Don't tell anybody. Yeah, so don't believe everything you see on Zillow and Trulia and all those things, because you know what? They don't have all the facts. It's a good basis from which to start, but don't make that the be-all, end-all, okay? Because if you do, you may be disappointed or surprised. All right. Don't skip the inspections. Check your emotions. Don't get so like, oh, I love this house, I gotta have it. I'll give whatever they want, I'll give it to them. Don't do that. Be reasonable, right? Think about your budget before you get in there, and then take the position of, I really like this house, but if I don't get it, there'll be another one. Right? So don't get too emotionally wrapped up where you make bad decisions. I want to tell you a secret. Home values do not always appreciate. In fact, in 2009, home values went down. In 2010, they went down again. In 2011, they went down again. And they finally start stabilizing in 2012. And so don't expect that just because you buy a home, the values are already going to automatically go up. The trends are, well, over the last 30 years, home values in our regions have increased about 8% a year. 8% a year. But there have been years where it didn't increase. In fact, it went down. There was a time about 3 years ago where we had lost about 40% of the home values in this region because we had this huge thing that was called a recession. People didn't have jobs. Okay. All right, so don't underestimate the repair needs. So get your property inspected, have somebody go out and give you a quote on how much it will cost to get these things corrected. Make sure you do that because you may get in over your head. Anybody ever hear of the money pit? Was that called the money pit? Anybody see that movie? Yeah, don't buy a house like that. All right, so the other side of it though is that don't be so rigid that you're unwilling to make some concessions. For example, you may have an ideal thought of, I want to have a 3-bedroom, 2-bath house in Sherman Oaks, south of the boulevard, and I only want to pay $300,000. Right? Today, that will buy you the garage. Okay? So you need to be more willing to accept. Maybe you'll think, well, maybe I'll drive out to Santa Clarita or the Simi and get that 3-bedroom house for maybe $375, instead of, you know, having this rigid idea of what you're going to get on the size of the condition. Oh. All right, so did I get this right? Yeah, next steps, make a decision, call us. All right, get your loan pre-approved. We have what is called a wish list. The wish list it's a form, it's about 2 pages, it takes about 15 minutes to fill out, and it tells us exactly what you wish. So if you say, you know, I wish to have a 2-bedroom, 3-bath, I want to have, I don't want to be on a busy street, I want hardwood floors, whatever you say you want, we try to focus on that. And we give you access to our website, which has, anybody here of the multiple listing system? The multiple listing system is where all the realtors store their information. And so you might go to, have anybody gone to Zillow before?
Yeah.
You ever saw a property and you called the agent and they said, oh, I don't see that. Oh, it's no longer available. Have that happened to you? Well, because, thank you. Because a lot of these other portals do not keep their information up to date. The realtors must, because we get fined. And most people don't like paying a fine for not having their information up to date. The realtor's information has to be within 2 days fresh. Whereas Zillow, Trulia, and a lot of the other ones, they don't. They'll keep it up there as long as they can keep it up there and get you calling so they can refer you to an agent. All right, so that's it. Any questions?
Yeah, we'll take 2, 3 questions, 4 questions, if anyone has anything else.
Repeat the question, we will. Yes?
Why is it the best time, you said the best time to buy is between Thanksgiving and?
Yeah. Well, why is it the best time to buy between Thanksgiving and the second week in January? Because typically people are spending money shopping, right? There are gifts and all those kinds of things. And so they're not looking for homes as much. So if you are a buyer and you are prepared to buy during that period of time, I can assure you, you'll probably be able to get 2 to 3% below what you would have gotten a few months earlier because you have less competition. And also, the sellers are tired of people going in and out of their house. They're preparing for holiday, parties and all that stuff, and you're going through their house, and they have to keep their house clean. They'd rather make a transaction that's acceptable to them and you, and they'll make some concessions that will be to your advantage. Most of the investors are really out looking at this time because they know that this is the time to really buy a home. Yes. Did that help you?
Yes.
Okay. Yes.
Oh, I was wondering how far in advance to get the loan pre-approved letter, if there's a limit to how far in advance we should get that before seriously.
Well, I would say get it right away. If you're thinking about buying a home and you're going to close this, you want to move in and get your keys within 2 months, I would say get your pre-approval so that, because the letters, how long is the letter good for usually, guys?
3 months.
About 3 months?
3 months.
Okay, so about 3-month window. Yes.
If the house you're renting has a lot of problems in it, and you've had an inspection and proving there are problems, why is it better to get the landlord to fix those problems before you buy the house from him or her, as opposed to buying the house at a cheaper rate? What's the difference?
Okay, you want me to repeat that? Just kidding.
I don't know.
All right. If you're renting a house and you're thinking about buying it and it has a bunch of deferred maintenance or problems with it, why is it better to get the owner to make the repairs before you buy it? It may not be. It may not be. You may decide that I don't want the homeowner to do shoddy work. I'd rather them lower their price or give me a concession like paying a portion of your closing costs, paying something as a credit toward the repair work that you want to have done. So it may not be better for you to do it that way. Okay? Yes?
So you mentioned the appraisal, and I was wondering what happens when the appraisal and either the asking price or the offer differ by much? Like what happens then if there is much of a gap?
Okay, so what happens if there's a gap between the appraised value and the accepted offer price, right? Well, if, for example, if you are trying to buy a property for 400,000 and the appraiser's for 410, start doing the happy dance, because you can still buy it at 400, okay? But if you're trying to buy a property for 400 and the appraiser's for 390, you have leverage. You can go back to that seller and say, look, I'd love to buy your house, but you know that darn bank over there, they don't think it's worth it.
But in a seller's market, you would imagine that some offers are a little higher than what the realtor thinks the home is really worth, because you're competing with other buyers, right?
Right. Well, it's not just the realtors, the sellers. A lot of sellers are the ones who are driving this whole thing. So, you know, you still want to have the appraisal. And I've had situations where the buyer decides, I want to make an offer, there's 5 other offers, I'll make an offer above the asking price, and it appraises for substantially lower. Now, what's happened is when the seller accepts your offer, guess what? Those other 5 buyers are on the sideline now. Now it's just you and that seller engaged. And so now you have leverage to push that seller's value down closer to your value and the appraised value. Okay, I
Thank you,
think,
Mel.
thank you.
Let's give him a hand.
All right.
With us, B of A, there's probably a mortgage rep sitting in that branch. And I would suggest whenever you're going to work with any mortgage rep, you probably want to work with somebody who you have some confidence with, somebody you are familiar with. I wouldn't yellow page it. It might be somebody that was referred to you by a coworker, by mom or dad, or by your local bank, something like that. It's somebody where you have some sort of familiarity with. I would venture to guess that during the whole home buyer process, you won't speak to anybody any more than the person who's handling your loan. You'll speak to them at the beginning, in the middle, the end, hopefully afterwards. That's why it's so important to get good communication going. And we're sure we're working on that now.
Yeah, no, you're good.
Are we good?
Yeah.
Can I hit it? Look at that. Cool, we're in there. So I'm going to start off, and I'll be very basic, and I want to be very brief because I want to let my 2 colleagues come up and speak. Our main goal is to get you guys familiar with what you will be facing as far as qualifying for a loan, what type of documentation you will need to submit, what you can kind of expect through the process, and there are different programs which you guys can use that a lot of people are not aware of that are available for people to help them with the down payment, to help them with closing costs, whatever the case might be. Just to start, home ownership, it is a good thing, and it is a great time to buy a house. A lot of people are saying, well, prices are going up. I'm buying something today that I could have bought maybe a year ago for less. Why would that be a good thing? Would you rather buy a depreciating asset or an appreciating asset? So it's actually a good thing that we're seeing prices raise, and they're raising at a constant level. It's not one of these, well, I'm buying it today for $1 and I could sell it next week for $3. That's what was happening maybe 10 years ago, and we ran into a little bit of a problem if you hadn't heard. So it's a very good time because interest rates, as Mel mentioned, are very low. You can probably get most interest rates at 4% or below in most cases, depending on the program that you want to use. It is long-term financial stability. It's probably the most important asset you'll ever buy in your life. As Mel mentioned, there's a lot of advantages to owning a home versus renting. Is everybody aware of the different parts of buying a house that is or possibly can be a tax deduction? When you make your payment, the interest that you pay on your mortgage payment is oftentimes 100% tax deductible. Are you aware that your property taxes are tax deductible? A lot of different pieces where if you're paying a rent check, you're basically paying somebody else's mortgage. So it's to your advantage if you're able to do so to make your dollars go a little bit further for yourself. We mentioned the tax. Compare apples to apples. So a lot of times, another thing Mel alluded to was if you see it on the internet, it may be too good to be true. And if it sounds too good to be true, it's probably not true. So if you see somebody advertising an interest rate of 2.5%, call us today, call online, call us now. There's probably something weird going on there. Maybe they're charging you an excessive amount of fees to get to that interest rate. They may not be offering a 30-year fixed rate. It might be an interest rate that's fixed for a minute before it jumps up to about 5%. So you want to make sure whenever you're comparing your loan programs, Are you being charged the same origination fee? Are you being charged the same fees for the bank? Is it the same program? Is it fixed for 5 years, 10 years, or the full life of the loan? These are things that you definitely want to make sure you're getting straight up front.
And you'll be telling us the general range of origination fees?
Origination fees can vary from 0 to as much as you want to spend. So, in other words, there's a rate sheet that'll range from the top to the bottom, and in order to get to the very lowest rate, there's an origination fee that's attached with each one of those rates. And you can get the choice to pick any one of them that's in that realm. How many of you guys, we saw before, how many people have bought a home before? When you bought the home before, what was one of the pieces of paper that everybody told you, probably since you've heard it since you were 15 years old from your parents even, what piece of paper are you supposed to get from your lender? With all the fees on it. Everybody hear about good faith estimate? So we're supposed to go and ask for a good faith estimate. You know what happens today if you ask for a good faith estimate? You don't get one. So what's happened recently, there's been a lot of changes with regulations that has come down from the government, and some of the disclosures now have changed. As you can see up on top, a good faith estimate and the initial TIL, which was a truth in lending, have been combined into one new disclosure called a loan estimate. It's a little bit easier broken down for people to look at, see what the closing costs are, what the rate is, what the APR is, and you get an idea of what you're getting yourself into right up front. Different regulations, and I don't want to get too deep into it, are requiring the lenders to hold off on proceeding with a loan until you've had a chance to review all these documentations and we get something back from you guys saying, yes, I want to proceed with this loan. And until we get that from you guys, we really can't proceed with this loan. At the very end, the final HUD, which was a list of fees that comes from escrow, along with the final truth in lending, which came from us, has been combined into a closing disclosure. This goes out to you guys when the loan process is all finished and we've underwritten you guys and you guys are approved and we're ready to get docs out and everybody's screaming, I need my loan docs, and now we got to say, wait, can't get your docs out just yet. The closing disclosure has to go out to the borrower, and you have a 3-day period where you need to now review these before we can even send loan docs out to escrow. And it cannot be waived. This is a law. It's not a company, it's not a banker idea. This is what the government has pushed down upon lenders to make sure everybody is understanding what they're getting themselves into in a transaction. These are the two documents, the loan estimate, and the intent to proceed is the piece of paper or the disclosure that we get back from you guys that tells us that you do want to proceed with it. Getting pre-approved, you can get pre-approved for up to what the amount that you can qualify for. And again, as Mel reiterated, that doesn't necessarily mean that's what you have to use. Spend what you guys are comfortable with. Don't spend more than you are going, you don't want to be just working for your house. I want to have dinner every once in a while. I want to go to a ball game. I want to do something besides pay my mortgage. So that's important. These are different questions to ask. Again, when you're trying to figure out what type of loan you're getting into, what kind of term am I getting? Is the interest rate fixed or adjustable? When are the payments due? Are they due on the 1st or the 5th? Do I have a choice? What happens if I make a late payment? Will I have to have my taxes and my insurance included in the mortgage payment? These are all things you want to find out right up front so you know when you get that first bill, there's no surprises. I am going to forward now to...
Oh, hold on, can you or your colleagues hold the mic closer in the direction of your mouth?
Absolutely. Unfortunately, I don't know if this is really
It's just right
doing
over
much.
here.
Okay, at this moment, I'm going to pass it along to Jackie, and she's going to let all you guys know what kind of documentation you guys will be expected to submit, what it's going to take to qualify. I'll pass it over to Jackie. I don't know if this works.
I'll try to talk in here. I don't think, it doesn't sound like it's working.
Jackie,
That-
that's to the camera.
Yeah, that little one.
Oh, where's, is there another one?
No, the one
Just the one
straight on the
standing there.
desk, that's like the speakers, yeah.
Okay. So the first thing that we'll talk about is credit. That's gonna be one of the main reasons that you're gonna come to us. We need to check that as the very first thing. So the scores, there's 3 bureaus, Equifax, Experian, and TransUnion are the 3 that we pull from. So it's called a merged report. We're gonna pull from all three, and we're gonna use the middle of the three scores. They can range from 300 to 870. You typically wanna be at least over 600 or 620 to even kinda be in the ballgame. Which, you know, if you haven't done anything major to your credit or owned a house before, have late payments, you're probably okay. The credit bureaus, they look at payment history, so that can be on credit cards, on student loans, on a mortgage, the length of your credit history, so obviously, you know, when the younger you are, and I know a lot of colleges, they have credit cards for you to open, you don't wanna go and open too many, but you do wanna start opening credit cards and having some balances, you know, if you could pay off the balances every month, that's the best way to go, but it builds your credit. Newly established credit, so that's like getting cards open, getting stuff, you know, you don't, if they see a short payment history, it's not graded as much as it is if you have a long running history. Revolving balances, so let's say you have a credit card that has a limit of $5,000 and every month you spend 50% of that balance and then you pay it off in full. That's the best way for your credit to go up. If you max it out all the time, the agencies don't like to see that because you kind of are, you see that you're pushing it to the end, and so that means that you're using up everything that you have. So if you can kind of stay in that 50% range, that's the best way for your credit to go up. Inquiries is people checking your credit. So every time you open a credit card, or if you go to a store, and a lot of times you can open up a card, let's say at Macy's, and get a 20% discount on your purchase. All those things are good, but every time they do that is they check your credit. And you don't want people checking all the time, because the more times your credit is run, it does kind of hit your score. I'm sure you've heard people say that. Like if you're looking for a car, mortgages, all the same thing. So I wouldn't necessarily, you know, kind of plan on what you're doing. If you're looking to buy, don't start, you know, going and looking for a car and going to all different places, or start looking into credit cards. Try to limit that and keep it just to the mortgages or to the banks. Also with credit, if there's more than one person buying, so let's say there's a couple buying or two people are buying a home together, they're gonna pull the 3 scores from each person and use the middle of the lower. So there are some programs that do it a little bit differently, but in the majority, it's gonna be the lower of the 2 middle scores. So just remember that if you're looking to buy with somebody, it's good to find out, you know, how their credit is, so that you can make a decision on, should we both be involved, should only, sometimes we remove one party if that person's credit is really bringing down the qualifications and the other person can qualify on their own. Then it might be good to maybe only go with that one person in order to get the better score or the higher loan amount or the better loan program. So just to keep that in mind when you're going into a transaction. So this is kind of revolving balances below 50% of the available limit. For bankruptcies, I know it says 2 to 4 years. This, from the discharge date, this has kind of changed over time. With short sales and foreclosures and all of that kind of coming around, 7 years is kind of the mark now, which I know seems like quite a long time, but so many people, especially in '09 and when that whole recession took place, you know, at that, when the few years prior, people were really buying properties up, and people were having rental properties, and then when everything went down, everybody went to short sales, they didn't have renters because people lost jobs and couldn't afford the rent, so it caused a lot of people to go late on their payments or give the homes back to the banks. So they've kind of extended this to, you know, when they tightened up the guidelines. So they kind of are trying to get a little more on the risk side of it. They feel it's too risky to maybe 2 years is too soon. So 7 years is a little more of the wait time, unless it's due to, let's say, an extenuating circumstance, like a death in the family, something, you know, it was a one-time event that happened, then you might be able to get away with it after 4 years. But if it's just the typical, you know, had too many properties or just couldn't keep it up, that's typically going to be much closer to 7 years. Then limit unnecessary inquiries. So just kind of plan on what you're doing. You know, don't go get a new car right before you go to buy a house, kind of like what Mel was saying. And you're adding that monthly payment to your overall expenses, and you have people checking your credit. Income is the second portion that we look at when you come to us to get pre-approved. So this is usually what we need. If you're a W-2 salaried employee, we need 2 years of your W-2s and about 30 days worth of your pay stubs. If you're self-employed, 2 years of your personal and business returns. So if you have a partnership, we're going to need to see 2 years of that as well. And especially with self-employed, that's a pretty big deal. In order for us to really evaluate the strength of the business, we're going to need to see 2 years of that. New jobs, it's not a problem if you switch companies, as long as we have documentation to show the new job, the offer, what your salary is. If you change from, you know, a W-2 employee to going all of a sudden deciding you want to open your own business in that same line of work, that's going to be tough, you know, to just do that right away. But if you go on a W-2 job where we have a way to actually verify what that salary is, then that's no problem. Gaps in employment, usually we can just get a really good letter of explanation from you explaining what happened, or did you move, or, you know, you were laid off, you were looking for a job. So just to kind of detail it out so we know what's going on. And then declining or inconsistent income, we usually need a pretty good detailed explanation of that if we see a trend in something. So usually we like to have those explanations for the underwriters ahead of time to give them an idea of what the circumstance was. Assets is kind of the last piece. So this is going to be your down payment, your reserves, what you have when you come to us to get pre-approved, so we know what kind of down payment we're looking at, and what, after the down payment, what you have left over in the bank for, let's say, X amount of payments in case something were to happen and you lost a job after the fact. We need to see that you have the ability to make these payments. So we usually want to see 2 months of your bank statements, all pages. We want to see where the money came from. So if there's any large deposits, like all of a sudden, you know, you have a standard savings account, all of a sudden there's a deposit of $7,000, which doesn't seem consistent with the rest of the money in the account, just know that we're going to probably ask, where was that from? We're going to need to see a canceled check. We, you know, which I know sounds kind of a little invasive on our end, but even though it's your money, but we have to know, you know, they're so big into fraud that it wasn't just, they don't like cash that was under the pillow and then just got deposited in for the purposes of purchasing. So it's a good idea to, if you know that you're going to be purchasing, to have 2 months of clean history of statements is always a good thing, because that's the amount that we're going to need. Also for gifted funds, which is a big thing now, that you can get from family. You can have them help you with the down payment or a portion of the down payment. All of that can be done prior to the application or during the application, so you don't have to have the money before you come to see us. You can do that as part of the process. We're just going to need a paper trail, and we can we'll explain to you exactly what to do and how to go about that. But you are allowed to have gifted funds, and some programs can even be 100% gifted funds. So you could have 0 down payment of your own, and let's say, you know, an inheritance or family gives you a 5% or a 3.5%, and that can be your complete down payment. So, and a lot of the loans that are in a conforming, which is kind of like the 417 loan and below, you don't even need to have that much in reserves after the fact. If you have a couple of months, you're pretty good. So you don't have to have, you know, X amount of dollars left over for us to see. We can use retirement accounts. Those are all accounts that we can use, stock accounts, as assets just to show in reserves. Yeah.
I was curious if the paperwork that you require changes at all if it's a jumbo loan versus a regular loan.
It does. It does.
Repeat the question, please.
He was asking if the paperwork changes if it's going to be a jumbo loan versus a conforming loan. And a jumbo loan are the higher valued loans. Let's say 625 and above is pretty standard for jumbo. On those ones, yes, they do require us to show, let's say, almost 12 months of your payments in the bank afterwards. The gifted funds works a little bit differently, so there are a little more restrictions. I wasn't going to go, we can always talk afterwards on exactly the differences, but it does change a little bit. The guidelines are a little bit more restrictive. So the retirement accounts are basically, we can use those, we can only use a certain portion. So, you know, if you show us those for reserves, we can usually use 65% of it. If you're, you know, not of a retirement age, which is going to be the case. So we can still use that, we just have to be able to take the lesser value and make it work. Gifts we kind of talked about, and that's pretty much, unless anyone has any questions or.
You want to hold the questions until after
Oh,
the
okay,
end?
that's fine. Oh, I guess one last thing I was going to mention is in the packets, I know you guys have a lot of paperwork in there. There is, I think right when you open it, there is one white paper, and it says submission to our file checklist. So in there, we'll have the list of all the documentation that we need, and it's really overwhelming. You don't need to bring in all of that when you come see us. If you pretty much just have your income and your assets, that's kind of what we went over. So anything that has to do with your down payment stuff and your income, that's pretty much it. The rest of it we can kind of pinpoint depending on your situation, what other documentation we would need. But that gives you an idea of just kind of what the items are that we might ask for or could ask for during the process.
Why is it better to get a loan through a bank as opposed to a lender affiliated with an accountant such as Robert Hall and Associates or something like that?
So there could be, I know, I'm not, either way can be done. It's not necessarily that it's better or worse. Typically what we find is when you go through the lender, or you go through a bank, and not like a broker, there's no incentive for us to charge you more. They usually charge you more on the broker side because they're like a third party, they have to make a certain amount of money off the deal. And a lot of times that loan ends up with Wells Fargo or with Chase after the fact. Where if you are the direct lender, like let's say for us, if we could do the loan with no cost, if we could do it at 2%, we would. It's no bearing on us, it's not us personally doing, we're just trying to give you the best deal. Wells Fargo is our employer, they're gonna pay us regardless, we don't have to try to, squeeze every dime or make money off of it because we're then in return gonna go sell it. So that's why I think there's a little more faith in what's going on, you just don't have to worry that there's, their side of it or something in it for them. There's, nothing whether what we charge you is not gonna make any difference on how we get paid, let's say. Versus on a broker side, it does make a difference. So that may be, and the other thing too is a lot of the realtors may refer you, let's say, to their in-house person. They have a broker who works at their place. There could be a little bit of a deal between, sharing the commissions between the two because they're kind of helping each other out. So that may also be a reason why they kind of steer you to go towards using their own in-house person versus you going on your own and making your own choice. So it's always good to at least check both sides so you can at least have a more informative choice of, getting the breakdown and seeing for yourself, what it is. Because at the end of the day, you choose who you want to use. They can't make you use anybody, Does that kind of answer?
Thank you.
Thank you, Jackie. Alright, good. So what I'm going to do, I'm going to be going over all the different programs that are currently available to help you purchase a home. You, as soon as you go into the bank, you're going to check your credit, we're going to check your income, we're going to see what you're pre-approved for, and we're going to give you an idea of what you qualify for. Now I'm going to take a little step back and going back on the credit and asset piece. On most of the programs with the banks, they are a lot stricter, but with the banks themselves, they've been coming up with newer programs to help clients purchase when they've had a short sale, when they've had a foreclosure, depending on their income. So there are newer programs which are called like portfolio on the programs where you could purchase a home, you could purchase a home with after 3 years on a short sale or after 3 years on the foreclosure. And then on the conventional side, they are a little more stricter, so they do want to see like 7 years on a foreclosure, at least 3 years or more on a short sale. When it comes to the BK, 2 to 4 years is still typical, but that's when we start looking at the different scenarios that are available, and there are different programs that we could actually use that are actually within the programs themselves. Okay, so what I want to go over is most of the programs that are currently available within the city of LA, the county of LA, Ventura, throughout the state of California that are currently available for you guys to help you guys purchase. Besides the typical, the 3.5% with FHA, the 3% with conventional, the 5%, the 10%, and the 20% down, there's also programs that could help you with the closing costs, with the minimum down payment. So you could come in with as little as 0 down and not have anything in the bank, which we really don't recommend. Again, it'll be good if you guys have some sort of reserves in the bank. So we don't want you guys to come in and not have anything, and then you guys are stuck with the payments and all that stuff. So you do want to have something, but there are programs to help you purchase. Now, within your stack in there are a few flyers on the different programs that are up here as well. So if you guys have those in there, they kind of explain a little more about each program. But there are programs through the state of California that offer anywhere from a 3 to a 5% grant. You could use this with an FHA loan. On an FHA loan, you need as little as 3.5% down, right? With this grant here, you could use this grant to help you with the down payment. So now, if you get the 3% grant, it covers 3% of the 3.5%. If you get the 5% grant, it covers your whole down payment plus part of the closing costs. So that's one of the programs. With the Couch FA, they actually just increased it. It went from 3% to a 5%. And then they have another program that we could tie into together with that, which is called the ZIP, which is an additional 3% more. So you could get a total of 8% down for down payment and the closing costs through on the Couch FA, which covers all the state of California. Main difference between the two is that with the Platinum, you don't have to be a first-time home buyer. You could sell your home today and not have no money from the sale of your home and then use the grant to help you purchase your next home. With the CalHFA, you have to be a first-time home buyer, so you can't have not owned a home within the last 3 years. Okay, and there are income limit requirements on most of the programs. With the LIPA, that's another program that's offered throughout the city of LA, which includes all of the San Fernando Valley through San Pedro. They give you up to $60,000 to help you purchase a home. That $60,000 you can use towards your down payment and the closing costs, and you're only required to come in with as little as 1% down of your own funds. So as you guys can see, there are different programs that are available to help you purchase, whether you're a first-time home buyer or whether you're just moving up to your next home. There are income limits, depending on your low income or the moderate income, which on a few of the flyers that are in there, they go over that as well. And then with there's one, yeah, you have a question?
Sir, the LIPA program, is that a grant or a loan?
The first one, the Platinum, is a grant, the CalHFA is a loan, and the LIPA is a loan as well. Now, every now and then, some of the nonprofits in the areas come up with actual programs, if you stay in the home for 5 years, or 10 years, or 15 years, that they'll forgive it. And there's some that come up with 10,000, 15,000, 30, even I see as high as 75,000. But that's, every now and then, it depends on their funding, when they get the funds from the state, from the county, and from the government. But the LIPA, which is the city one, is a loan, and you do have to pay that back when you either you refinance, you sell your home, or you pay off your loan in 30 years. Okay, but there's no minimum payments on it, so it helps you purchase more home without having that additional expense. So you're actually buying, if you're buying a home at $350 with the program, you're actually paying like if you're buying a home for $290. So that's the good thing with the program. So it does help you, it's for low income on the purchase assistance. So these are a few of the programs. There's a few other ones out there as well, but these are a few that are available. Then one other thing I wanted to speak about as well is the Mortgage Credit Certificate Program, which that flyer is in your handouts as well. Which that's not a loan or it's not a grant, but it's a federal tax credit. So if you're a first-time home buyer buying a home within the city of LA, which includes all the San Fernando Valley, all the way to San Pedro, they give you either a 15% or a 20% federal tax credit on the annual interest that you're paying on your home loan. Which there's an example on the flyer as well, which I'll break it down and I'll show you guys. That's great. If you're a first-time home buyer, you can take advantage of this program. You don't have to use it with none of the other ones, but it gives you an additional tax credit besides the ones that we've been speaking about as well, which is the interest and the tax deduction. It gives you a dollar for dollar, either 15% or 20% credit towards your taxes. So these are all great programs that are currently available that could help you guys out, either with the down payment, with the closing costs, or even just for taxes at the end of the year, or you could break it down on a monthly basis as well. But this is kind of a quick thing on the different programs. I can stand up here for a few hours going over each one, but I know everyone wants to go home too. But there are the flyers in the program, so you're able to contact us as well. But and there's websites for each one also, so if you guys want more information, more flyers on them also. Okay. And besides that, we're open for some questions.
Do you know what the qualifications are for the grant program?
For the grant, it goes by income limits. It doesn't go by household size the way the CalHFA one does. The CalHFA goes by depending how many people are in the household. The grant goes by only who's on the loan. So for within LA County, for a house, whoever's giving a loan, it can't be more than $80,155 for LA County. For Ventura County, I believe right now it's at $98,000. So if you have two people that are, let's just say husband and wife, that are looking to purchase, but we don't need both of their incomes to help you guys purchase, we only need one of the two, then we could just put one person on the loan and use the grant to help you guys purchase, and we don't have to count the income of the second person. So each program is a little bit different, but the top one's considered on the moderate income, CalHFA is considered low to moderate, and the LIPA is considered low income.
So I related to what I was said before about having the 2 credits and then choosing the lower one. So if you're coming into the process as a couple, it seems like you guys can take all the information that we give you and you sort of play around with all of the different possibilities, going in the loan only one person, even though a couple and everything else, I mean, you're gonna consider, it's not like we have to tell you what we want, you guys are gonna figure it out for us.
No, definitely. When you guys could come in, we're gonna ask you guys, we're gonna check your guys' credit, we're gonna check your guys' income and debt, and then from there, we're gonna give you guys different scenarios. We're gonna give you guys scenarios with, depending how much money you have in the bank, how much you could use for its assets and retirement accounts with gifts. And then from there, we'll give you guys an example if you wanna go with this program or this one over here. So, and you might start with one program and decide, you scratch that and you end up going with another one. So yeah, so we're gonna give you a whole bunch of different options depending on your scenario. Because if you're over the income limits on all the programs, we could give you guys a quick, brief description on it, but obviously you're over this, so we're gonna shy away them.
One of the components of a loan estimate is a TIL. What does TIL stand for?
That's the truth in lending disclosure.
Oh, okay.
But the TIL is no longer, it's been combined into the loan estimate,
Right,
which is a
right.
lot easier to read because we combine them both in together and it kind of flows through.
Right, okay.
Two questions. First, student loan debt, does that affect your debt to income ratio?
Yes, on the student loan debt, before September 14th, on an FHA loan, we didn't have to count it if you were still in school. After September 14th, they're still gonna count it, so we're gonna wanna see the minimum payment with both conventional and FHA loans.
Is that 2015 or 2016?
As of September 14th of this year, that just passed. So now we do have to count the student loans before September 14th. FHA did allow us to exclude the student loan debt if you were still in school and we could get a deferment letter for 12 months or more. Now that has changed, now we have to include it, so we do want to ask you guys to try to get a letter, try to extend the term as much as possible. There's no prepayment penalty on the student loans, but extend it as much as you can to get the lowest payment possible so it doesn't affect our debt to income ratio as much. That's a good question because it just changed.
If you've misplaced your W-2s, is there a way to get a copy?
On the W-2s? Yeah, with the W-2s, you could go online to the IRS, if your employer can't find them or they can't get them over to you, you could order your tax transcripts or your W-2 transcripts online. So there is an option on there, which I know before was a lot easier, you could just click on them and print them, but I think now you have to put more information and they mail them out to you now.
Oh, okay, thanks.
But you could get them faxed to you if you guys are in a hurry and you're trying to close escrow and we need them. So if you're willing to wait, because I've had some clients stay on the line for like 2-3 hours on hold, and they'll fax them over if you're standing by the fax. That's their requirement, because they're gonna have you read the confirmation number off there.
Okay, thank
Okay.
you.
Anything else? Good.
Any additional questions for Wells Fargo?
Yeah, I do have a question. So if you go with an FHA loan, does that mean your PMI is higher? Like your property mortgage insurance or?
Well, FHA just recently lowered on the PMI, so that they were a lot more expensive, so we were trying to get everyone over to the conventional loan.
Sure.
But FHA did just lower the PMI, and it's not as affected as much as on a conventional loan as it is on an FHA loan when it comes to credit score. But on FHA, they did change it, they lowered the PMI, but now it's for the life of the loan unless you're putting 10% down or more. So the only way to remove the PMI now, which is the private mortgage insurance, is to refinance to a conventional loan. Unless you're putting 10% down or more, then it falls off in 11 years. On a conventional loan, it's 2 or more years if you start with PMI, but you could only remove it if you owe less than 80% of the value of the home.
Okay. Good evening, everybody. My name is Morgan. I'm a real estate attorney. And I'm going to tell you today about what happens after you've turned in all of your bank statements to Jacqueline and Fernando's gotten you into some awesome loan program, and you've seen Mel at his office and he's helping you, and you went ahead and found the perfect house and you've signed your purchase agreement, your offer's been accepted, you're ready to go. Now what happens? Now, you're in your escrow period. And this is the time when you need to really pay attention to the actual condition of the property that you're about to purchase. So, what does the seller have to tell you? Basically, the seller is under an affirmative duty to disclose anything that affects the value of the property. Agents, Mel also has an affirmative duty to disclose anything that affects the value of the property, and that's
something that's developed recently, within the last 30 years or so. The courts have set down rules that say who has a duty to do what. And agents have a duty to tell you the things that they already know about, and also things that they should know about. So if there's a big crack in the wall in the back bedroom of this perfect house you're about to buy, and your agent went in there and the light wasn't good that night, and no, I didn't really see it, your agent still has a duty to tell you about that crack, because the agent should have seen it. Now, that doesn't prevent you from seeing it, but we'll get there. So they have to conduct an inspection of the house. That's really important. Your agent is under a legal duty to conduct an inspection. But the courts and the law also say something else. So not only does the seller have to tell you and your agent has to tell you, but you yourself have a duty to look at the house and to conduct an inspection of it so that you know what you're getting into when you purchase that home. So, Civil Code Section 1102 sets forth the duties of agents in terms of disclosures. And there's a form that comes, pretty much the language is directly from 1102, and that's called the Transfer Disclosure Statement. There it is. I want you guys to study it. I'm going to quiz you on the concept.
You also have a copy of that form in the brown envelope that you have.
Yeah.
All the forms that she's showing you, we've given you a sample so you could take home and review them.
So that 6-point font that form is velvet with the 1/4-inch margins, that's where the seller tells you all about the condition of the property you're about to purchase. And you can't really see here on the slides, but you can look on your forms. In the middle of this first page and on the second page, there are a bunch of boxes that can be checked, and that's where the seller pretty much lists what's in the home. You know, does it have a carbon monoxide detector? What are the rain gutters doing? Is there a pool or not? And do you know, seller, anything that's happening with any of these major systems of the home that I, as the buyer, need to know about? In addition to your transfer disclosure statements, there are a whole list of forms. They go on and on and on. And that's part of the problem. On the one hand, it's great that you've got all of these written disclosures about every aspect of the home that could ever possibly occur. But on the other hand, as a buyer, you're confronted with pages of forms. It can get overwhelming. And so when people go into overwhelm mode, what happens? You stop paying attention. But that's the time when you really need to be paying attention. So be proactive about the whole process. It's really important that, and I can't stress this enough, and I shouldn't have to say this, but read the forms. You're about to sign off on all of them. And when you're putting your signature down on that form, you should know what's in that form. You're in your agent's office and they're talking to you and you're really excited, but you're overwhelmed and you're just signing. Stop and read. What are you signing off on? This has been mentioned a few times. Don't waive your inspections. Don't waive your inspections. That is very, very important. This is probably the single biggest purchase you're going to make in your life. That deserves a moment to take some time and review what's on those papers that you're signing. You also need to take an active role in the due diligence process itself. I'm not talking about just putting your name and reading forms. You should be hiring an inspector to come in. I'm no construction expert, I don't pretend to be, but I know that I can call people and have them come in and take a look and see what's going on and tell me, is there a big crack in the ceiling? Is there water damage? Is the house tilting to the side? If it is, that's a problem and we need to take a look at it. Maybe there's a problem with the foundation. These are all problems you want to discover now before the close of escrow. Because if you discover them after the close of escrow, that's a whole other ball of wax that we don't necessarily want to get involved in. You want to get a certified home inspector. Mel mentioned this earlier, Uncle Joe is not the guy that you call in this time. Uncle Joe's great, and you can come and look at the house, but you also need a certified inspector. Anyone can call themselves a home inspector, you want them to be certified. Oftentimes, inspectors will try and limit their liability to the price that you paid them to come in and inspect, and that's $200-300. So if there's a problem that's discovered later that the inspector should have seen, and you try to sue the inspector, and there's a clause that says their liability is limited to $200 or $300, that's a problem, especially since courts have upheld that limitation. So you want to make sure that your guy is certified. It'd be great if you had some insurance too. You want to pay attention to all the details of the house, the foundation. What is there? Are there any drainage issues? Fences? Trees? Are there tree roots going into the pipes? What are the neighbors doing? Is there a chicken coop 2 doors down that's gonna, the rooster's gonna wake you up every morning at 4 a.m.? That's something you wanna know now. Open the closets, look in the cupboards. We have an inclination to not want to be nosy or embarrass somebody, and believe me, that still runs strong when you're going in and looking at the seller's house. It's still their house. It feels weird, but you need to do that. You're spending hundreds and hundreds of thousands of dollars. It doesn't necessarily take a trained eye to see some of these problems either. I mean, if you look for them, you'll find them if they exist. Except for things like mold. This is when your inspector really comes in handy. You can't see mold, mold is a problem. There's a whole booklet in your packet that lists all the different types of environmental problems that can occur with real property, including mold, radon, asbestos. Are you on a fault line? That's a good thing to know. But these are all problems that occur, and we're going to be confronted with them, but let's hope that we know about them before we close escrow and not get surprised by them afterwards. There are also other disclosures that sellers need to make. Is it in a planned community? If you're buying a condominium in a planned community and it's governed by what are called CC&Rs, which are conditions, covenants, and restrictions, and they're recorded with the county recorder's office, they govern the use of the property. So maybe you buy in a condo association and they all need to be painted the same color. That means when you buy your condo, you don't get to come in and paint it red. The CC&Rs tell you, no, you can't do that, and you have to abide by them. And the seller needs to disclose whether or not CC&Rs exist for that particular property. Some of the other things I need to tell you about, are there any pending litigation claims? Usually there's a homeowners association that is formed. They have to have insurance. How much money do they have in their bank accounts? These are things that need to be disclosed when you're buying into a planned development. New construction, well, it sounds like there wouldn't be any problems because it's brand new. Sometimes there are, depending on the type of builder that's being used. I've heard of cases where it is a new construction and things didn't go well. There were major pipe issues and water damage. So once again, and I can't stress this enough, get a qualified home inspector to come in and look at the property. When your qualified home inspector issues you a report, read the report. We had a case recently where the seller sold the property, the buyer bought it, got a home inspector, was issued a report, didn't read the report, talked to the home inspector. The home inspector didn't go over every detail of that report. So, the buyer discovers a problem, sues the home inspector, wants to know why that wasn't pointed out, but admits to not having read the report. That's a problem for that buyer. So again, they need to disclose anything that affects the desirability of the property, anything that's going to diminish the property's value. Deaths on the property, those need to be disclosed too if they've occurred within the last 3 years. Once again, you wanna know if you're next to an airport. Are you 2 doors down from a toxic dump? Are the neighbors gonna be partying every night until 2 a.m.? You want to know that. So don't just go during normal daylight hours when everybody's at work and the neighbors next door are gone and the party hasn't started yet. Go at night. You know, drive by the area at 10 o'clock at night and see what's happening with the neighborhood. Is it a high crime area that, you know, is discoverable really only after dark? You can go there anytime and find out. Park your car, get out. Is there a lot of noise or is it quiet? These are things you want to know now. And the point, of course, is to avoid unpleasant surprises. Mel touched on this earlier, that the agent representing somebody has a fiduciary duty. And that's a duty imposed by the law, and it's the highest duty imposed by the law. So your agent needs to disclose everything they know about the property, everything they should know about the property. And the other party's agent also has the duty to be truthful about any inquiries that you're making to that agent, even though they don't represent you. What should you do if you discover the problem during the escrow or the due diligence period while escrow is still open? Contact your agent. Maybe the agent has a solution. Maybe you can negotiate down with the seller, get a lower price on the property, get some concessions made. You asked the question earlier about whether or not the landlord should make the repairs or if you as the buyer should be making repairs. You know, that's a situation by situation decision. And if you discover a problem and you talk to the seller about it, maybe they'll knock some money off of the asking price as a result. If it's a major repair that you don't feel like undertaking, that's part of the discussion as well. So what happens after escrow closes and you discover a problem that you didn't know about? Usually you have a mediation provision and an arbitration provision in your purchase contract for the sale of the house. And what that means is, when you discover that problem that no one told you about, you have to go back to the seller and say, I want to mediate this dispute. And you have to do that before you actually go and file a lawsuit, or you waive certain other rights. But I can tell you from experience, it's a lot easier to deal with these types of issues now, before the transaction's consummated, than trying to chase someone after the fact. Chasing someone to try to get them to refund money to you is difficult to do. They may not be around anymore, we have no idea. Maybe they moved, maybe you can't find them. So, how do you take title? If you're married and you're acquiring the house now during your marriage and the down payment is being paid out of earnings that you and your spouse have earned during the course of your marriage, it's probably the case that it's going to be community property. If you're taking title as spouses, you're likely going to take it John Smith and Jane Smith, husband and wife, as community property with the right of survivorship. Or John and Jim Smith as spouses with the right of survivorship. What that means is that if one of you dies, the property passes to the other spouse automatically. If you're single or you're divorced, you're going to take title either as a married man or woman or as a single man or woman, and that just depends on whether you've been married in the past. Tenants in common is another way that people often hold title. And what that means is, if there are two tenants in common and one of them dies, the share that they owned does not automatically pass to the other owner. Their share goes to their heirs. So that's a really important distinction. In joint tenancy or tenants in common, one of them goes to the other owner, one of them doesn't. If you're holding it in trust, you probably have an estate plan put together and you have a trust created that you're taking title to the property in trust. And those are usually the common ways to take title. Anybody have any questions?
Before we take questions, because now
Just
we're
kidding.
gonna take questions from Morgan and Mel and our Wells Fargo team, I'd like to just introduce the CFO of the University Corporation, and that's John Griffin. John, if you stand up. And I'd also like like to thank all the people here who helped out with the seminar, our committee. And they include Liz Kiosis, who was at the registration table, Philia Militante, Lori Goldbaker, who's not here, Daniel Bichet, our cameraman back there, and David Evasian, our timekeeper. They are our real estate student assistants. Kyle Corum, who is our videographer tonight, and he's a student here at CSUN, and Dustin. Dustin, what's your last name?
Laura.
Dustin Laurel. Dustin works in our sponsored programs department, but he's here helping us out tonight as well. So thank you guys, we appreciate it. So we're gonna open it up now, the whole house for questions, and feel free after the question and answer period's over to help yourself to some dinner. And our presenters will be around, and you can get them one-on-one, ask them additional questions or have some comments. But thank you all so much. We really appreciate you coming. And oh, by the way, this presentation, the entire presentation will be on the University Corporation's website under real estate, our resources website. Okay? All right, thank you. Open up for questions.
You had your hand
Wait,
up, go
hold
ahead.
on. I was just reminded of something very important. Our survey. Inside of your folders, we really need your feedback so we know, how you felt. We should do it again. This is our fifth one. Every year we've got really good feedback and great comments. And also, if you happen to buy a house because you came to the seminar and it was helpful, let us know. We appreciate that. We have several teachers who attended the seminar and purchased homes afterwards. It helps us to know. It looks like this. It only takes you a couple minutes. You have to dinner and ask questions.
You want to ask another question?
Yeah, go ahead.
No. Who's got questions? Go ahead.
My husband's a veteran, and so he has the VA loan available to him. So how does that change all of the rules of debt to income ratios and down payments and all of those kinds of things?
There are programs for veterans. You need to get his certificate of eligibility. And when you speak to one of us or whoever you're speaking to, you just mention that he is eligible for veteran benefits. And we can go over the different programs for veterans, and they have great benefits. It's no money down with no PMI. Certain debt ratios and other things to qualify, but it's a wonderful loan.
Thank you.
Yes. Yes.
If you're about to get married, but you buy a house before you're married, so how does the title work?
You can take title, and you can change your title at any time, how you take your vesting. If you're going to close your escrow prior to being married, you're probably not going to take it as a married couple. Your driver's licenses just won't match up, and that's how they're going to notarize you. But let's say you close your escrow on November 1st, and you get married on January 1st. On January 2nd, you can go and just file a deed of trust, changing your vesting into his and hers, married, however you want to take title at that time. You don't have to go through a refinance process.
I would also ask too, is it one person's income primarily that's being used to pay the down payments and all of that? Or if it's both of you? I mean, if it's both of you, then yeah, go ahead and change title, but if it's just one person who's putting everything into the property, at that point, that's still considered your separate property, and so you may have some other considerations around issues of title at that point.
Okay.
So you should talk to someone.
Yes.
Jacqueline was talking about, when it came to credit, the income, about inconsistencies, right? So some of us as lecturers, sometimes we get summer classes, sometimes we don't. Sometimes we get 3 classes per semester, sometimes we don't. Do banks take that in consideration, or are there particular programs that are specifically for educators that take those particular problems or situations into account?
Yeah, I mean, I don't know what we can all say, but it's gonna be, there's a lot of exception bases, and I can't really say 100%, would it work, would it not work? Basically how we handle that typically, because there's not a consistent monthly where, you can't rely on necessarily how many you're gonna get every time. So a lot of times, let's say you've been doing it for 2 years, they might look at the 2 years and give you an overall average, and average it out and say, okay, overall average comes to X amount of dollars per month if I look at the 2-year average. They might wanna have, if we have less than 2 years, we might have a little of an issue because they won't be able to really, 2 years is a big mark for using any kind of bonus, commission, income like that that's not consistent, where they can kind of average it out to get what they feel is a fair, consistent mark to gauge you by. So usually how we handle it is, we would have to say it has to get looked at by an underwriter who's gonna make the final decision. We give a very good detailed explanation explaining how the income works, there's not necessarily a particular program, but we try to do our best in explaining it. We try to show them as much as we can for consistency. We probably would do a verification for, how stable is this to go on for the next 2-3 years, and then that's kind of how we would present it to the underwriter to see if they would make a decision on that, on the income. So that's kind of why when everybody says to get pre-approved before you go out to make the purchase, is because especially with an income like that, that's not a straightforward W-2 person where there's not a monthly set income. We want to make sure that whatever the loan amount that we're looking to do and the income that we're wanting to get approved, that it does get approved ahead of time, so that we know when you go out, okay, we feel comfortable that if you do make an offer on this property, that income would be supported. So it's kind of an exception based, there's not really a straight answer for you, but it would be kind of an overall picture that we would be presenting.
Thank you.
Anybody else? Jump up front.
Yeah, I had a question about the inspections and all of these closure forms. What's the time window when all this happens? I imagine that it's when you're already in escrow, and if the escrow is 30 to 45 days, if I understood correctly, is it the whole of the 30 to 45 days they have time to bring up any issues that might have?
Generally, the due diligence period starts 17 days after the date that the purchase contract is signed. And so, once that's 17 days, then your inspection period begins. There's a point too before the close of escrow where you're waiving certain things, you're saying that you're done. So it's kind of in the middle of that escrow period, 17 days after you start. You don't have that long, so it's good for you to get everything lined up and ready to go. Once that 17-day mark hits, you start your inspections right then.
Okay, and with all these disclosures, like, I know that the analogy may be a little extreme, but sometimes you get these notices that you have to update your operating system in your computer, because otherwise
Right.
none of your programs will work.
Sure.
And then you have to agree to the terms and conditions.
Yes.
Or else.
Right.
So is there, I imagine that it's not the same, but to what extent can we, once we see all of this information, say, wait a second, no, I don't wanna go ahead?
It depends on what's happening. Like I said, you can use that as leverage to drive down the price of the purchase. You can make demands that the seller fix certain things. So it's not one of those adhesion contracts, sign or else type of situations. And if it's a really material problem that's gonna affect the value of the home, you as the buyer certainly do not need to continue that transaction.
What's the difference between a co-op and an HOA?
Well, an HOA is a homeowners association.
Morgan, I can't hear you.
Okay, sorry.
That's okay.
A homeowners association is it's like a board of directors that's organized for that planned unit. And you'll pay HOA dues, so every month you have a fee that you need to pay to the HOA, and that money is then used to make certain improvements on the property, to keep the common areas clean, that type of thing. So that's the purpose of the HOA. And then the
Co-op.
Co-op, I'm not really sure what situation that a co-op.
But I was looking at a townhouse in Woodland Hills that's part of a co-op.
Okay, so that's the same thing, basically. It's part of a planned development. You pay a certain fee every month to have certain things done at the property. There are probably restrictions that prevent you from doing certain things. You know, it has to look like this, you have to have this type of window shutter, you can't deviate from the norm, which is why they all look the same. Otherwise, everyone would paint theirs a different color. So it's some sense of uniformity on the development. So it's, you know, there are restrictions about the property when you're buying into one of those planned developments. But the good thing about it is that the grounds are maintained. You know, maybe you have security on the property, the lighting, you know, never goes out because they've got maintenance people there fixing these things for the benefit of the residents. Does that make sense?
Yeah, there are some co-ops in the West San Fernando Valley and Woodland Hills area off of, I want to say Topanga Canyon and around there. You'll find out that the values on those are a lot less than they would be for those that are non-co-ops, and partly it's because the co-ops are harder to finance. There's only a limited number of lenders, maybe one or two, versus, you know, hundreds of lenders that will actually finance a co-op. So I would look very carefully at it before I made a decision to buy a co-op, because it's not as marketable in the future when you want to sell it. You won't get, the value won't appreciate as much as a condominium will.
So what's the distinction between the co-op and the condominium? Because I'm not really familiar with the co-op concept.
You know, I can't give you all the details on it, but I believe it has to do with the ownership and whether it's shared all together or not.
Shared ownership,
Yeah.
and there's reserves, and
Right.
there's investments that go along with it.
I
Right.
see.
Well, there are reserves in a homeowners association.
Yes.
All the homeowners have, the state law requires them to have a set of conditions, restrictions, and covenants. Also, they have a budget. They have they're required to have reserve funds in it too that will be in place in case the roof or any other the common areas deteriorate over time and you want to replace them. So you want to look, for example, if you're buying a condominium, you certainly want to look at the financial statements of the condominium. You want to get a copy of the budget. You want to look at the reserve funds. You want to look at the ratio of owners versus non-owner occupants, things like that.
And there are also, you know, whether or not there are any pending litigations against the homeowners association, whether they've had problems with anything in the past, those are important too, because those affect the financial outlook of the HOA.
I don't know who would be best to direct this question to, but I have a question regarding receiving a gift amount and using it towards your down payment. So if you're receiving a gift from parents or in-laws, so if two parents, married parents are trying to give gifts to a daughter and a son-in-law, can anyone comment on the max before there's tax implications for a gift tax, and then if there's any guidance on how they should issue checks?
So we can tell you how much of a gift is applicable towards a loan. As far as the tax implications, I'm going to defer on that one. I don't know if that might be something more in your field.
I think the gift tax threshold right now is $13,500, but it's the giver, you know, that has some tax implications.
Okay, so then, do you know if it's, the mother could give up to $13,500 to the daughter and then another $13,500 to the son-in-law?
Yes.
Okay, thank you.
Okay, well, if there's no additional questions, again, thank you all for coming, we appreciate it. And we really hope that you did get some information that can help you with your buying process.